Welcome to this explainer. Today, we're going to completely demystify Chapter 6 and 7's dense fixed income math, and we're turning it into a dynamic, easy-to-remember masterclass. Honestly, if you've ever looked at bond pricing formulas and just felt your eyes glaze over, you are absolutely in the right place. We're going to break the whole shebang down so it actually makes perfect sense.
Okay, let's dive into this. We're going to cover Section 1, Calculating Price and Yield, Section 2, Decoding the Yield Curve, Section 3, Fundamental Bond Pricing Properties, and finally, Section 4, Trading and Accrued Interest. This mental map is going to take us from the foundational math of individual bonds all the way to real-world trading settlement.
Starting off with Section 1, Calculating Price and Yield. Understanding a bond's value really starts with grasping present value. To truly get the value of a bond, you just have to ask yourself one question. What is a future dollar actually worth to us right now? Because, as we know, a dollar today is worth way more than a dollar a year from now. So we have to discount those future bond payments. It's really just a logical four-step process. First, we pick our discount rate based on the current market. Second, we calculate the present value of all those regular coupon payments we're going to get. Third, we figure out the present value of that big principal repayment waiting for us at the very end. And fourth, we literally just add them together. That total is exactly what the bond is worth today.
Now, what's really interesting about this slide is that sure, the general formula looks incredibly heavy and intimidating, but actually, scratch that, it's just a literal translation of the four steps we just talked about. It's simply adding the discounted value of every single future coupon plus that final future value at the very end. Once you see the logic, the math just becomes a tool.
And that brings us to the absolute most important measure of yield in the bond market, yield to maturity, or YTM. If you're taking an exam, this is the ultimate number you need to deeply understand. It's not just the interest the bond pays, it's the total return you expect to earn if you buy it today and hold it until the end. But here's the kicker. It assumes you reinvest every single coupon payment at that exact same rate. It wraps up the purchase price, the coupon rate, the time left, and the final payout into one neat little percentage.
But here's a fascinating question that always trips people up. Did you know that investors regularly buy bonds at a premium? Meaning they literally pay more upfront than the bond will actually pay back at maturity. Why on earth would anyone purposefully buy something that guarantees a capital loss at the end?
Well, the answer is all about the cash flow. A bond's true value isn't just its purchase price. If a bond is trading at a premium, it's usually because it pays a high coupon rate, higher than what the market is currently offering, right? That stream of fat, regular coupon payments more than offsets the initial premium you paid. Plus, you get to continuously reinvest those high payments to earn even more. It's the total package that really counts.
Let's move to Section 2, Decoding the Yield Curve, and see how this builds from individual bond math to the macro market forces.
So the term structure of interest rates is typically plotted on a yield curve, and a normal, upward-sloping yield curve tracks yields across maturities, illustrating a very basic market reality. Investors generally demand higher returns for locking up their money for longer periods of time. But why exactly does the curve take this specific shape? Well, there are three main theories. First, the expectations theory. Think of this as the market trying to predict the future. Current long-term rates are just foreshadowing where investors think short-term rates are headed. Second is the liquidity preference theory. Imagine the super cautious investor. They prefer the safety of having their cash totally accessible, so you literally have to bribe them with a premium to lock their money away for 10 years. Finally, the market segmentation theory. This treats the market like different neighborhoods. Commercial banks like to hang out in the short-term neighborhood, while big pension funds live in the long-term neighborhood. The curve's shape is just the result of supply and demand in those segmented areas.
Moving right along to Section 3, Fundamental Bond Pricing Properties. Now we're going to zoom back in to see how those macro market rate changes actually impact specific bonds.
Okay, if you remember absolutely nothing else from this entire explainer, you must memorize this golden rule. It is absolutely crucial for your exams. Bond prices move in the opposite direction of interest rates. They are on a giant seesaw. When interest rates go up, bond prices go down. When interest rates drop, bond prices rise. Burn this inverse relationship into your memory.
And this brilliantly illustrates our next fundamental property, sensitivity to maturity. Look at this scenario. Both bonds start at a 3% rate, priced perfectly at 100. But when rates rise to 4%, the 5-year bond's price drops by 4.49%, while the 10-year bond drops by a massive 8.18%. The rule here is clear. Longer-term bonds are significantly more volatile than shorter-term bonds. The further out into the future you go, the more sensitive the bond is to rate changes.
Now let's contrast that with the impact of the coupon rate. Here we have two 5-year bonds, but one pays a 3% coupon and the other pays a 2% coupon. When rates rise to 4%, the 3% bond drops by 4.49%, but the lower 2% coupon bond drops by 4.58%. This proves another absolutely vital property. Low coupon bonds are more volatile in price percentage than high coupon bonds.
So, we know longer maturity means more volatility, and lower coupons mean more volatility. But how do we compare two completely different bonds? Enter duration. Duration is the ultimate cheat code metric. It combines both the maturity and the coupon impact into one single powerful volatility score. If a bond has a duration of 10, it means its price will swing by roughly 10% for every 1% move in interest rates. It's the single best way to gauge a bond's risk. Finally, let's transition to Section 4, Trading and Accrued Interest. This is the practical reality of actually buying, settling, and paying for these securities.
You see, when you buy a bond, you don't just pay the quoted market price, which we call the clean price. You actually pay what's known as the dirty price, which includes accrued interest. Because bonds usually only pay out their coupons twice a year, if you buy a bond right in the middle of a payment cycle, well, the seller held it for a few months and they deserve to be compensated for that time. So the buyer pays the seller the exact interest earned up to the day before the trade settles.
So the crucial point is exactly how we count those days. When calculating accrued interest, the denominator is always based on a strict 365-day calendar. Yes, even if it's a leap year with 366 days, the fixed income market practice universally sticks to 365 days.
To wrap things up, let's rapid fire through how these trades actually settle. T-bills, which are sold at a discount, settle on the exact same day you make the transaction, what we call T0. But for all other bonds and debentures, they settle on the next business day or T+1. And by the way, forget about the old movies where people lock physical paper-bearer bonds in a vault. Today, ownership is recorded seamlessly in an electronic, book-based format by clearing services. So, let's tie this all together with a practical exam-style scenario to test your new knowledge. If you confidently expect interest rates in the market to absolutely plummet tomorrow, which bond should you buy to maximize your gains? A bond with a duration of 2 or a duration of 10? Think back to our golden rule on the seesaw and our volatility metrics and see if you can solve it. Keep applying these tools, and I'll see you in the next explainer.